Hey everybody. Holy hell, it's been a minute. It's been what, almost a year now. But I've been working on some stuff. I've been working on my trading. I've been trading this entire time while I was off, just been focusing on doing my own stuff. But I have just created one of the biggest projects that I've ever done, which is a Notion document containing pretty much everything I know about SMC. This Notion document will be linked in the description, but this series will pretty much just be me reading off the the Notion document and then showing you examples in the charts themselves. I probably won't do live examples. I was gonna try to do that, but it's just my schedule is so busy. I'm not even at home when the markets are open, and I can only catch 9:30 to 10:30 before I have to actually go back out and focus on my own personal life and other businesses that I do besides trading. Now, yeah, so this, what I'm about to say here has already been written down on the Notion document. So if you've read that before, uh, you might be hearing myself repeat myself from the Notion document. I mean, of course. But this Notion document is a summary of everything that I have written in a Word document that I have on, or a Google Docs document, which is, it's a lot of pages. I think it was, I don't remember how many pages it was, but it has around 48,000 words on it. And then I also have two notebooks, which are 100 pages each, which are handwritten, which is pretty much just the same information, but I just wrote it down handwritten. So all of that knowledge has been put into that Notion document and just simplified to make it a little bit easier for you guys to understand and for me to understand when I'm teaching this. Now, these this series won't contain every single thing about SMC. This Notion document is the only thing that I have written down, or like the words that I have written down in a Word document will be in this Notion document, right? So I guess we just get straight into it, and uh yeah, I think I can just show you guys the Notion document itself, right? So I'll just do this and then let me see, like so. So here is the Notion document. Now let's just read through this first, and we will start with explaining the open, high, low, close, and liquidity today. So I will be reading just straight off this, so you can of course just skip pretty much this video or till we start explaining the liquidity and open, high, low, close. But I will pretty much just be reading this for you guys, right? That's what I will be doing. But introduction: in the world of stock trading, it's so easy to get overwhelmed and lost in the endless abyss of information that's out there. There are free ebooks, paid courses, and scammy YouTubers. It's tough to decipher what's good and bad, and as someone who had to go through the same scenario myself, I found it extremely annoying, so that's why I'm making this exact document, or video in this case. So you can cut out all the bullshit and get a complete A to Z guide on how to start trading stocks if you're a complete beginner. Now, I'm not going to do the usual scammy approach where I wrap this all up in a little bow and make you pay $299 for my course. The best part of this notebook is that it's free. So who am I? Hi, my name is Asi, often called Ace. I'm a 20-year-old Nordic trader with a year and a half of trading on my back. For the first 6 months of my trading career, I studied everything about the trading space and SMC. That is 16 hours a day for 180 days of pure study. I went through 4 notebooks, 160 pages on Microsoft Word, and 48,000 words on the document. So it was actually 4 notebooks, not 2. But yeah, this is what I meant. That's Grammarly. God damn it. Hold on. All right. Yeah, I took all of that info that was written by me, simplified it, and threw it here. My current win rate as of summer 2024 is 77.6%, and that's not counting BE trades or barely profit trades. My personal life is quite secret, and most people who know me don't know my intentions or my success, and I hope you do the same. Which, what I mean by that is, don't tell anybody that you're doing this. Icelanders who are reading this don't even know I have other stuff going on besides trading. That's how quiet I want you to be too. In short, I am a businessman, but just 2 weeks ago, it's been a lot longer now, trading profits surpassed my investments and monthly dividend income. That is why I want to make this document. Now, I'm not going to try to flex here, but trusting me is all up to you. I'm not going to try to prove myself for the sake of your trust. All I ask you to do for me is to study and find examples on your charts. So, what to expect? I won't show you how to set up TradingView or how to set up your tools on TradingView, because that is what Google is for. All I will do is simply teach you how the concepts work and how to use them effectively. I won't promote anything I do. You won't find my YouTube, my Twitter, my Discord, or even my Spotify playlist. Simply so you don't DM me to ask questions. Everything in this Notion document has all of your answers, so simply read it again till you get it. Wait. Anyways, what you need to forget everything you know. You need a notebook and a pen, TradingView, a Tradeovate account or a demo account on a prop firm or a live account, you choose, or the app Tradeovate and the demo account. An open mind, discipline, and self-trust. So let's get started. Facts, I guess we'll go through this. Can I trust this? You bought it, you decide. I was selling it, but I changed it to free because why the hell would I sell it? Question, will these concepts work on Forex or crypto? Yes, they work best on Forex, but I recommend futures to all beginners. Who are you? Your worst nightmare and Mr. Stereo Girl? How long till I get rich? Maybe in like 2 or 5 years, depends if you're him, but don't think of will you get rich, or enjoy the journey, right? This is not a get rich quick scheme. So that's why I said it like at least 2 years, but some people can get it quicker, but 2 to 5 years is the goal, right? How do I start? Study, that's how you start. What plan do I need on TradingView? Essentials and a CME add-on, or that's Chicago Market add-on. When I'm done studying, is it over? No. Now you need to put in the hours on the chart, collect market data. That's the most time-consuming thing of this all. So when you know every single concept by hand, like the back of your hand, the market data is next thing that will come. You will notice the market will repeat itself over and over and over again. So collecting market data is the biggest part of it. What do I do after I've studied this all? You study market data. The markets repeat themselves all the fucking time. With 1 to 2 years of market data in your head, you'll be unstoppable. How do I gather market data? Trade every day when markets are normal. Once you get your winnings or losing trade paper and pretend it's real. Take as many reasonable trades as you can in a day. That's with paper. On a paper trade or a fake account trade, take as many reasonable trades as you can in a day. Not with your prop firms or your live account, only with a paper account. And yes, you need to do this for a whole year. So every time you're finished with your one trade on your live or demo or prop firm account, switch to paper and take reasonable trades. This is a key word. Reasonable trades as often as you can in a single day. All right, next up. So this is the AI text of the New York Stock Exchange. I will not be reading this. I will be reading this. The New York Stock Exchange is mostly automated now, but there are still professional traders on the floor. We, however, are not professional traders, so never sign any agreements saying you are one. That's one expensive mistake. Now, what I mean by that is that when you sign that you're a professional trader, they will charge you like quadruple or quintuple what you normally pay because you're a professional trader. You're gonna make money, so you can't afford the additional data. When buying and selling stocks, there's also someone against you. So if you buy a stock, someone else has to sell it for you so you can get into their position. Now, shorting a stock. Shorting is a weird thing to think about. Making money while it goes down. We need to remember that when you are short, someone else is buying. The agreement says that if you short a stock, let's say 400, and it goes to 380, your agreement between you as a seller and them as a buyer is that you can buy your stock back at the original 400, even though the stock sits at 380, making you a net profit of $20 before commissions. I hope this makes sense, because in my head, this makes perfect sense. Futures. Let's read this. The general info. Futures, aside from being the title of Jimmy World's best album, refers to a market where you can buy and sell contracts for commodities or securities. Commodities including grain, soil, oil, etc. while for securities, the most popular ones to trade on the futures markets are the S&P 500 and the Nasdaq or the Dow. These all three correlate with each other, or they should, but we often see Dow or YM go pretty much against these two, so I have stopped looking at the Dow Jones. We will be trading the Nasdaq and looking at the S&P 500 and the Dow Jones. This is what I don't look at Dow Jones, but of course you can. Whatever strategy works for you. In futures, there are a few key things that interest me. Firstly, they are leveraged, meaning you borrow money from your broker. This arrangement magnifies small price movements into significant profits or losses. For instance, if you're using a 10-to-1 leverage, a 5% price movement would result in a 50% change in your investment. Secondly, the futures market operates about 24 hours a day, allowing you to trade just about any time. Thirdly, futures contracts don't suffer from time decay. Unlike options, where the closer you get to expiration, the more it loses in value. Futures don't have this issue. Lastly, there is no pattern day trading rule with futures. With stocks and options, you can only make 3 round day trips if you have an account with less than 25k in it. This can be tough for people who are just starting and want to day trade. However, futures contracts are not subject to this rule. P.S. You don't put any money into a trade. If you lose, your loss will be withdrawn from the account, and if you win, it will be added to your account. I hope this makes sense too. How money works in futures? Let's use the E-mini S&P 500 as an example. One point is comprised of smaller units of measurements known as ticks, which represent the price movement to the right of the decimal point. For the S&P E-mini, one tick is 25 cents, meaning that there are 4 ticks at one point, which equals to $1 of movement. The value of each tick varies based on the underlying asset. For instance, if you're trading something like gold or oil, the tick values will differ. In the context of the S&P E-mini, each tick has a value of $12.50. Since there are 4 ticks in a point, 4 times 12.50 equals $50. Thus, a 1 point movement represents a $50 change. If you have a smaller account, you might not want to trade an asset that can significantly impact your balance. For that, there are micro E-mini features, which are more affordable. These micro contracts are 1/10 of the size of the standard E-mini futures, making them well suited for smaller accounts that will stand to participate in futures action. These contracts will have an M in front of the ticker. For example, ES is the S&P E-mini, while MES would be the micro S&P E-mini. It's good to know that there are also nano contracts, which are 1/100th of a mini, but those are only for really high value futures contracts, such as Bitcoin and Ethereum. If you're bearish on an index that you're trading, meaning you think the price will go down, you will sell a contract to enter the trade and then buy the contract to close the trade. Conversely, if you're bullish on an index, meaning you think the price will go up, you will buy the contract to enter the trade, then you'll sell a contract to close it. When trading futures, it's advisable to have levels set when you enter a trade that will exit the trade automatically when it moves in either direction. These levels are called take profit and stop loss. When you enter a trade with these levels already set automatically, it's referred to as a bracket order. If your take profit levels hit, it will automatically close the trade and cancel your stop loss order. If the inverse is also true, If your trade starts moving against you and it hits your stop loss mark, it will close the trade for you automatically, cancel your take profit order. Holy hell. You can also set these levels manually or adjust them when you're in a trade. Just remember to cancel your orders when one gets hit. What app should you use? Firstly, use a demo account till you feel comfortable trading with real money. Next, get a funded account on a preferred prop firm. I recommend ATF.com. Use my code for a discount. It varies from 71 to 90% off. Explaining how prop firms works is hard to do in a text, so please Google that. It will ease my workload a bit. That was a long set of text that's my mouth has started to foam. Now, let's explain Forex, because Forex is the most traded, stock, I could say. Forex trading, also known as foreign exchange trading, involves the buying and selling of currencies on the foreign exchange market to make a profit. Forex is the world's most traded financial market, with a transaction totaling more than $5 trillion every day. Forex trading works by simultaneously buying one currency while selling the other. This is because currencies trading always happen in pairs, such as Euro USD, GBP USD, etc. The exchange rate between two currencies is the amount you'd need to spend in one currency to buy a unit of the other. Traders make predictions on whether a currency pair price will increase or decrease based on economic indicators, news, political events, and other factors. If their predictions is correct, they earn profit. For example, if you think the US dollar will rise against the euro, you will buy the USD Euro pair, buy USD, sell euro. If the US dollar does rise in value relative to the euro, you can sell the pair for a profit. Now, cryptocurrency, just no. Non-fungible token, fuck no. And SMC concepts, this is just a separate to tell you that these are all the concepts here. So I'll be making a video for pretty much every one of these. I'll try to fit as many as I can in a single video, but some might just need a single video, right? So that makes sense. So if you're just starting to trade, this right here is really important. This might be hard to understand, but this will be really, really good to understand, right? I hope that makes sense. But the open, closing, high and low prices is something that you need to keep in mind all the time, even on higher time frames, because that is what we call the power of three. And we will go over that pretty soon. But for now, let's just start with the basics, right? So candles. Green candlesticks are bullish because the price appreciated and went upwards for the time period. Red candles are bearish because the price depreciated and went downwards for the time period. What do I mean by time period? On TradingView, you can choose your time period. We will mostly trade the 1 minute time frame, but keep an eye on the 5 minute, 15 minute, 1 hour, and 4 hour. Of course, daily too, but that's not too important. So candles form depending on the time period. A 1 minute time frame means that every 60 seconds, a new candle will form. For every hour, every 60 minutes, a new candle will form. Understandable? Good. Let's move on. This rectangle area is known as the candlestick's body or the real body. These lines that stick out above and below the candlestick's body are known as the wicks or shadows or tails. For green candlesticks, the opening price is at the bottom of the candlestick's body, and then the close price is at the top of the candlestick's body, aka open, low, high, close. For red candlesticks, the opening price is at the top of the candlestick's body, and the closing price is at the bottom of the candlestick's body, aka open, high, low, close. The wicks end at the top, representing the highest price point of that time period. The wicks ends at the bottom represents the lowest price point for that time period. Now, what does the size of the candlestick body tell you? The bigger the candlestick's body represented momentum gain as price traveled greater distance during that time period. The smaller the candlestick's body represents momentum loss as price traveled a shorter distance during the time period. When you have a very small candlestick's body or close to no body, this is known as a doji, which represents indecision from buyers and sellers because the price swung up and swung down during that time but then closed to the same price as when it opened, from which means buyers and sellers got nowhere and again shows indecision. Doji candles are good to know about, but we rarely pay attention to them. I'm just adding it here simply so you understand when retail traders talk about doji candles. By the way, from here on out, I will never mention buyers and sellers because this is what retail traders talk about. Now, if we look at this image, we can I make this bigger? Right here. Yeah. So this is the opening price down here of the candle's green candle body. It went all the way down here, went all the way up here, and then finally closed here. So if we go to the charts, right? Let's just take a look at this candle right here. Actually, it has no wick. This one right here. So it opened over here. It got all the way down to here. It went all the way up to here. And then it closed down here, right? So this is what the candle did. Opened, low, high, close, right? So this area here is the body. And then these over here are the wicks. Make sense? Good. So the bearish candle is opening up here, went up here, all the way down to here, then closing down here. So let's look at that. It opened up here. It went all the way up here before going all the way down here, just to close over here. As you can see, the next candle will always open at the last close. You can see it's the same exact price. All right. So this candle, it opened up here, went all the way up here, all the way down to here, all the way to here. Just fix that. I didn't mean to do that, but yeah. So this right here is the body, and then these are the wicks. Right? You guys need to know this. If this seems difficult, I don't repeat this video. I don't know. Right? So those are candles. I don't know what to explain besides that, because Power of 3 will explain candles a bit more. But let's take a look at liquidity, right? I think this is quite the, this is quite the stuff, as you can see. Liquidity, buy side, sell side, stop rate, engineered, and things to remember. So let's start. Liquidity. The best way to think of liquidity is where would I place my stop if I was in a shorts or longs. The market always seeks to take out liquidity. Think of it like the market hates to have people in the market, so it seeks to take them out. That's why we sometimes see the market go into stop hunts or seek and destroy, where they take every single trader out, longs or shorts. Liquidity pools are areas where banks and large capital traders place their orders and want to expect a market reversal. Banks have so many orders that they can't enter like us, so they rely on liquidity to enter their large trades. This liquidity sits on every swing high and swing low point on the charts. Finding which liquidity pool let's start over. Finding out which liquidity pool will get respected is where your expertise is tested. Best way to consider it, the higher or lower the swing point is, the higher the draw. Now, buy side liquidity. You might see this marked as BSL on my charts. This is where buy stops are placed, where people are short and place their stop losses at these points. Buy side liquidity is always above us. Sell side liquidity. Actually, let's take a look at this video. Right? So this is a swing point here. Now, what do I mean about a swing point? A swing point is 3 consecutive candles. We have 1, 2, 3. And you see this wick right here is the tallest of these two. You can see there's swing points pretty much everywhere we are. So if we go back here, I'll take out my highlighter right here. So this is a swing point, this one, this one, this one, this one, this one, this. All right. So what do I mean by that? You see there are 3 consecutive candles, 1, 2, 3, A, B, C. You see the B's wick is higher than A's and C's. Same here. B's wick is higher than A and C. B's wick is higher than A and C. B's wick is higher than A and C. Now you see these right here, these wicks right here have already been taken out. So for now, we can just get rid of them. Same with here, same with here, same with here. This one has yet to be taken out. Now, what do we call these? I just mentioned it just right then. These are called buy-side liquidities, correct? This is buy-side liquidity, where markets will draw towards anytime soon. We don't know when or how it will do it, but it will take this out sometimes in the future. Right? So these are what swing points are. 3 consecutive candles. The middle one has the biggest or the highest tip. Vice versa for, I'll teach sell-side liquidity first. Sell-side liquidity. You might see this marked as SSL on my charts. This is where sell stops are placed, where people are long and place their stop losses at these points. Sell-side liquidity is always below us. So let's take a look at this. You can see there's a swing point, A, B, and C. This wick is the lowest of these 3, which means this is sell-side liquidity, or a swing point, I should say. You see sell-side liquidity gets taken, we create a stop rate and go higher. I'll explain stop rates just soon enough, but let's take a look at this. So we have a swing point here, 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 here. You can see just by quickly scanning these, I see all of those. So you see candle A, candle B, candle C. This is the lowest point, creating a swing point. Candle A, candle B, candle C. This is the lowest point, creating a swing low. So these are swing highs over here, swing high. This is a swing low, all right? There's not much more to explain than that. If you don't understand it, then I don't know what to tell you. But sell side, this right here is sell side liquidity, and we might take this out sometimes in the future. With sell side liquidities, because buy side liquidity is always more likely to get taken out, right? Because markets tend to go higher. But with sell side liquidity, we often leave them behind, because if we look at like the weekly time frame, you can see there's a lot of sell side liquidities down here that we have yet to take out. Because like simply, if you go all the way down here, the markets will, like, everybody will go bankrupt. So let's just not do that, right? I hope that made sense. Whew. Stop rate. Stop rate is something we want to see. You don't want to see equal highs or equal lows. You want to see the price takes out liquidity, so it goes a bit above or a bit below the swing point to take out all the people who had their stop losses there. This is where we look to turtle soup. This comes later in the document. So if we take a look at this, you can see a stop rate. We go higher, stop rate of sell side liquidity, and this is a stop rate of buy side liquidity, and we continue lower. Now, engineered liquidity. Engineered liquidity it's a part of the market maker X model. This market will create liquidity for us to target later. If you see equal highs or lows, we might not take it out straight away, and we will come for it later. That's engineered liquidity. Now, engineered liquidity, what I mean by that is that from all these, like when we took this dump right here, actually I can explain. I think it's better to explain this, right? So we have all this sell side liquidity down here. And here, just turn this on here. And we also have a low right here. It did get taken out on ES. So this actually got taken out on the S&P 500, right? It's called SMT. It's also in the document. But yeah, this is engineered liquidity where the market, it will take out buy side liquidity. It will create a stop rate right here. Sorry, where was I? Oh, you're right. The stop rate. So this created or took out buy side liquidity, created the stop rate. It got a SIBI entry, an inverse fair value gap, and it started to take out all of the engineered liquidity, right? So back to this. This is engineered liquidity. It goes both ways, right? I guess I'll show that too. Let's do the 15-minute time frame actually. So find a bullish example. This is hard resistance liquidity. Is there anything good here? Maybe this. Can do like this and then 1 hour. Cool. Right. So this all here would be the. I think this right here would be liquidity. This right here would be liquidity, and then finally this right here. All of these are engineered liquidities, right? We probably have an SMT down here. Let me see real quick. Yeah, we do. So this is SMT, which pretty much means buy side or sell side was taken. But yeah, so it takes out liquidity. Get this line out of here. Takes out liquidity and starts to go for all of the engineered liquidity. I really hope that makes sense. But it's just the market creates highs or lows for us to take out later. Things to remember, liquidity is everywhere, but it might not be as strong as some. So what do I mean by that? Is that if we go back down to the 1 minute and you can see like, let me see. When we create high resistance liquidity, it's not as strong. As you can see here, right, this is liquidity taken. It is. Liquidity is everywhere. But this low is a lot stronger liquidity pool than this one, or even this one. This liquidity pool is a lot stronger than this one. However, this is still sell side liquidity taken because price is fractal. I'll explain that later. But the higher the time frame, the easier it is to spot greater liquidity pools. Go too far, and every single candle low and high is liquidity. What I mean by that, so like 15-minute time frame, right? Reset charts. You can easily identify where the liquidity pools are, right? Here's a liquidity pool that got taken out today, and here's one too. So we targeted that one, and you can see we created the stop rate and immediately went down. But if we go to like the daily time frame, you can see that that big ass liquidity pool that I was talking about is now the high and the low of this single candle here, which means that this low is a liquidity pool, this is liquidity, this is liquidity, so is this, 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 so is this. You understand? Every single candle will become liquidity if you go on such a high time frame, right? Don't disregard a swing point simply because it's so close to the current price. Sometimes the tiniest liquidity pool is enough to finish the distribution of price. Something very important to remember and have in mind at all times: the market seeks to take out liquidity, rebalance imbalances, rebalance equilibrium, generate liquidity. We will go over this again in finding draw on liquidity. So yeah, this sometimes the tiniest liquidity pool is enough to finish the distribution of price. As I was just showing you just now, right? Market is bullish, right? Right here, it's been bullish, but this tiny liquidity taken with this imbalance right here, I think, yeah, this one right here, with this imbalance, this is what we call inducement, but we'll get to that later. With this liquidity taken, we finish the distribution higher, right? We don't need to go all the way down to here to rebalance this price. We can just finish going higher. Now, are there more things here I can look for? I mean, same thing with here. I mean, we kind of want to get to this SIBI over here, right? But this liquidity pool up here, even though it's tiny, it's enough to take us back lower, right? Don't disregard a single liquidity pool just because you can when that liquidity is enough. However, don't just long and short of every single liquidity pool you see. It's more of a confirmation than an entry, right? Or a confluence. But I think that's the first two SMC concepts, liquidity and candles. I hope I explained that fairly enough. If you have any questions, let them know in the comments below. If you want me to go over some of this again, please let me know again. Anyways, my name is Izzy. Take care.